Tax Tips Tuesday on 105.9 The Region.
With tax season just around the corner, KPMG is here every Tuesday with Tax Tips Tuesday. To help us get us started is KPMG in Canada's tax partner, Joseph Pagliaroli. Joe, how are you? Welcome back.
Thanks, Jim. Nice to be back.
Well, it's great to have you back. Today we're here to talk to business owners about some of the tax implications of choosing between paying yourself with a dividend versus a salary.
That's right, Jim. The choice you make here has tax implications and can also impact other areas of your financial planning, such as your retirement. The main difference is that with a salary, you pay less corporate tax, but more personal tax because it's deducted from your business as an expense. With a dividend, you pay less personal tax, but you pay more corporate tax because it's paid from after-tax corporate dollars.
Oh, so it's just a matter of deciding whether you want to reduce personal taxes or corporate taxes.
That's right, but there are other considerations as well. So for instance, if you're someone who has trouble saving and CPP may form most of your retirement income, then you may want to choose a salary because CPP retirement and disability payments and RSP contribution room are based on your salary income and not dividend income. Also, certain personal tax deductions such as employment expenses can only be made against salaries, not dividends. And because dividends are grossed up on your personal tax return, they can hurt your eligibility for programs such as the Canada Child Benefit or lead to clawbacks of things like your old age security payments. If you want to keep your overall income low, then choosing a low salary might allow you to increase such credits as the Canada Workers Benefit. But remember, paying a low-level dividend might mean you're in a lower tax bracket where you may not be able to take full advantage of dividend tax credits.
Well, those sound like some really good reasons to choose those salaries. So why might you choose the dividend?
Well, if you plan on leaving funds in your company for an extended period, then this offers the opportunity to defer additional personal income tax and allows you the flexibility to maximize lower tax brackets by deciding to pay dividends over a number of years rather than an annual lump sum payments. One reason to choose a dividend is to save on CPP payments. Because CPP is paid on wages, neither the company nor you, the shareholder, will have to pay into CPP if a dividend is used. Another reason to choose dividend is that companies pay a high rate of tax on investment income, and dividends can cause corporate refunds on these high corporate rate taxes, but salaries can't. Also, if you take a salary, the company can potentially end up with a loss that can't be used for tax purposes. This means you'll pay personal income tax without the benefit of a corporate tax deduction. On the other hand, a dividend won't generate losses that won't be used, and dividend tax credit will be available on your personal taxes. One other thing to consider when making the dividend salary choice is that paying a salary requires the company to set up a payroll account with CRA and remit payroll taxes on a monthly or quarterly basis. This can add to the administrative burden of the company, so it can be easier to pay a dividend. Of course, then you run the risk of having to pay quarterly personal tax installments if you owe too much personal income tax at the end of the year.
Well, it sounds like there's no one solution to suit everyone, and you should probably consult an advisor before you decide.
That's probably a good idea, Jim. Yes, I agree.
As always, Joe, thanks for the great tips. We'll talk again next Tuesday. If you missed this week's or last week's Tax Tips Tuesday, go to our Twitter feed at 105.9 The Region, or as always, kpmg.ca.
Tax Tips Tuesday with KPMG in Canada on 105.9 The Region.